This is Jody Trana with Chapter 3, Part 1 of Principles of Accounting. There are two ways to record transactions: the cash basis and the accrual basis. The cash basis records transactions based upon the receipt or payment of cash. Under the cash basis, revenues are recorded only when cash is received, and expenses are recorded only when cash is paid. Accrual basis records the effect of each transaction as it occurs, not when it's received or paid. Revenues are recorded when revenue is earned, and expenses are recorded when the expenses are incurred. Most businesses use the accrual basis, so it's very important for us to learn it. This is what we will be using from here on out. The accrual basis of accounting provides a better picture of a business's revenues and expenses. It records revenue only when it has been earned and expenses only when they have been incurred. Under accrual basis accounting, it is irrelevant when cash is received or paid. Accrual basis accounting is required by generally accepted accounting principles. That's GAAP. Cash basis accounting is not allowed under GAAP. Let's learn the GAAP rules that support accrual basis accounting. The first GAAP rule is about timing. This rule says that the business activities can be sliced into time slots. It also determines that businesses must be run on a fiscal year that's a 12-month year. Some businesses have their fiscal year end in months other than December for their own convenience. The second new GAAP rule is about revenue recognition. Remember, we have had two accounts about revenue. One is service revenue. This is an equity account. We use that account when we have provided services and have received money or the promise of money in accounts receivable. The other account related to revenue is called unearned revenue. That account is used when we haven't earned the revenue yet. We have received money but haven't done the services yet, so this type of account is liability, as we have an obligation to either repay the money or provide the services. This concept of revenue says that we must record revenue when it is earned. In our example where people have promised to pay us for services we've already performed, we would indeed record this as revenue because we've earned it. Getting paid for it may be an issue, a different issue altogether. The third new GAAP rule is about matching. One of the main reasons that we have accounting, and specifically accrual basis accounting, is to report our profits. That can only be done if we're careful to match the right revenue with the right expenses. This has mostly to do with posting revenue and expenses into the right time period. If we've received some revenue for services provided, we need to post the expenses related to providing those services in the same time period. Let's take a closer look at what it means to earn revenue. The revenue recognition principle guides when to record revenue and the amount that must be recognized. Under accrual basis accounting, revenue is recognized when it is earned. The earnings process is deemed complete when the seller has either delivered a product or performed a service. Let's look at the difference between a cash basis system and an accrual basis system for expenses. Suppose on May 1, Smart Touch Learning paid $1,200 for insurance for the next 6 months. We often pay insurance ahead of time. Under the cash basis method, Smart Touch Learning would record insurance expense of $1,200 in May. This is because the cash basis method records an expense when cash is paid. Alternatively, accrual basis accounting requires the company to prorate the expenses. Smart Touch Learning would record a $200 expense every month from May through October. You can see that the accrual basis in allocating $200 payments per month shows a more accurate view of expenses as related to revenue. Now let's take a look at how those differences would affect revenue. Suppose on April 30, Smart Touch Learning received $600 for services that will be performed for the next 6 months, May through October. Under the cash basis method, Smart Touch Learning would record $600 of revenue when the cash is received on April 30. The accrual basis method, though, requires the revenue to be recorded only when it is earned, that is, when Smart Touch Learning is providing the services. In this case, Smart Touch Learning would record $100 of revenue each month for the next 6 months beginning in May. In accrual basis accounting, we use accruals and deferrals to put revenue and expenses into the right time period. An adjusting journal entry is made at the end of the accounting period, and it's used to record revenues into the right period in which they are earned and expenses into the right period in which they are incurred. Deferrals defer the recognition of revenue or expenses to a date after the cash is received or paid. Accrual adjustments are the opposite. An accrual records an expense before the cash is paid, or it records the revenue before the cash is received. It's more important for you to understand the concept of deferrals and accruals than to try to memorize which one is a deferral and which one is an accrual. We'll talk more about this. Adjusting entries are always made at the end of the month to make sure that the revenue that we're recording matches with the expenses that we're recording. We want to have the most accurate income statement possible. So let's take a look at the journal entries and associated T accounts for this transaction. On December 21, a law firm pays Smart Touch Learning $600 to provide e-learning services for the next 30 days. What is the original deferral journal entry? At this point, we're going to use our cash account because we received $600, and so cash gets a debit, and we're going to use our liability account, unearned revenue, for $600 as a credit. We've collected cash for services that we need to provide in the future for the next 30 days. So we cannot claim this as service revenue until we've actually earned it. Our T account for unearned revenue would show a $600 credit on December 21. You probably noticed that when we posted that journal entry, it was on December 21, and there were 10 days left in the month. So now let's assume that during the last 10 days of the month, Smart Touch Learning performed 1/3 of the services. That is, 1/3 of the money is now earned as real revenue. What is the adjusting journal entry and for how much? First, let's take a look at the journal entry itself. We had previously posted a credit to unearned revenue, and we need to now take that out of unearned revenue and move it into service revenue since it is now earned. So unearned revenue gets our debit because it is decreasing our unearned revenue account, which has a normal balance of a credit. And we will be crediting our service revenue account to increase it because service revenue has a normal balance of a credit. The amount is $200 since that is 1/3 of the original posted amount of $600. You can see with our two T accounts here what it looks like when we move $200 out of unearned revenue and into service revenue. We've now reduced our unearned revenue down to $400, and the $200 goes to increase our November and December balance in revenue. Here's some guiding principles to think about as you are writing your journal entries to adjust revenue or expense. First of all, they're usually written at the very end of the period as an adjusting journal entry. Second, they never, ever, ever affect cash. And third, because we're always trying to get our revenue and our expenses correct so that our income statement is correct, we are always either adjusting a revenue account or an expense account. Your book provides a really good guide to end of the month adjusting journal entries, both accruals and deferrals. This is provided to you also in Canvas as a handout, and I would recommend that you go and get that if you do not already have one. A very common deferred expense is depreciation. The reason we use depreciation is because when we buy assets, we post those assets at their original value, at their cost, historical cost, but they don't stay valued at that amount. More often than not, those assets will decrease in value. We also are purchasing those assets specifically for the reason to increase our sales. So the cost of those assets we want to allocate against our sales in one way or another. So it's twofold. We want to reduce the value of assets to more accurately report the assets that we have in our business. And we also want to allocate a portion of those assets against the revenue that we're receiving. So here's the things that you need to know in order to calculate depreciation. First of all, you need to know the original cost or the basis. That is the historical cost of that asset. You need to know the residual or the salvage value. That means how much is that asset worth at the end of its useful life when you sell it. And then third, we also need to know the length of time that we identify as a useful life. Here we have a graphic of a vehicle that was purchased in year 1 for $4,000. We're going to say it has a useful life of 4 years and that it will be worth nothing when the vehicle is done being used. If it's going to be used for 4 years and it had an original purchase price of $4,000, then the depreciation every year is $1,000. Each year we will allocate $1,000 of that, take it out of assets and put it towards expenses, and by the end of year 4, our value on our balance sheet will be 0, and the asset will be fully expensed against our revenue. We have 2 goals with our reporting of assets. One is to depreciate the value of the asset over time in order to match revenue with the expenses of that asset. But we have a second goal, and that is to continue to show that asset on the balance sheet for as long as we own it. Here you can see how the vehicle would be reported on the balance sheet for years 1 through 4. We report the vehicle at its original cost, and each year we deduct the accumulated depreciation from it. So on the balance sheet, we show both of our goals, our original asset cost and the depreciated amount. If we did not keep these amounts separate, the 2 amounts of the original cost and the depreciation amount, if we simply deducted an amount every year from the vehicle account on the balance sheet, by year 4, the asset would be eliminated from the balance sheet. But doing that doesn't accurately reflect our company. Even though it's fully depreciated, we do own a vehicle in year 4. Showing the vehicle at its original cost and deducting the accumulated depreciation from it to show each year's net vehicle book value helps us to meet our 2 goals: to show the original cost of the asset and to show the depreciated amount. Let's use an example to see how straight line depreciation actually works. There are many methods, but we will generally use the straight line method in our accounting processes. So we need to be able to calculate what depreciation will be each year and then do the journal entry for that depreciation expense. We have a situation here where we have furniture that was purchased for $18,000. We believe that that furniture will have a residual value, no value, of 0 when it is completely used after 5 years. We need to calculate an annual depreciation amount and then determine what the journal entry would be. To calculate depreciation, we would take the original value of $18,000 and subtract any residual value, which in this case it's 0, and divide that amount by 5 years. We'll get an annual amount when we do that of $3,600 per year, but we need to also know our monthly depreciation so that we can post this monthly. We divide that number by 12 and get $300 per month. Our journal entry is to debit depreciation expense furniture, which is an expense account and in the equity category, and we will credit accumulated depreciation furniture for $300. This account is a contra asset account. That means that it is in the asset category, but its normal balance is a credit balance, and its purpose is to offset the assets to show a more appropriate book value. Here you can see a section from Smart Touch Learning's balance sheet. This is just part of the asset section on the balance sheet. In this PowerPoint, we've introduced a new type of account, a contra account. A contra account is an account that has a normal balance opposite of the other accounts in that account category. Remember that we've said that all assets have a normal debit balance? That was true until now. Accumulated depreciation is an example of a contra asset account. A contra asset has a normal credit balance, which is opposite all other assets. Using this contra asset on the balance sheet helps us to meet some of the rules of GAAP. Let's take a look. Remember the cost principle? It states that the plant asset, when purchased, must be recorded at its original cost. It also states that the amount must continue to be shown on the balance sheet until the asset is sold. The corresponding contra account, the accumulated depreciation account, is reported in the asset section of the balance sheet to help show the accumulated depreciation and the netted amount of the new depreciated value of the assets.